Hey, so from time to time, I have clients who are looking to acquire a business with an SBA loan, and the business they're acquiring actually was not profitable in the last tax year. And maybe the very first question you should ask yourself, if that's you, is should I be paying anything for a business that was not profitable? Is there any value there? That's going to be the big question you should make sure you're really certain about first. But I think there are situations where, yes, the business could have been not profitable in the prior year or maybe prior couple of years, but for some reason, maybe it's you're going to bring some new business, some new strategy, a turnaround plan. You have a plan to be able to make the business profitable, or it's strategically important. Maybe you already own an existing business and this business you're acquiring is going to be strategic and they're going to find some ways to cut costs in the business. So now you'll be able to be profitable. There could be a lot of reasons why, right? And so the question is, can you actually use an SBA loan to acquire a business that's not profitable? So first of all, the answer is yes, you can acquire a business that's not profitable with an SBA loan, because you may talk to some lenders, you're probably going to hear them tell you that you can't, that nope, sorry, it's not profitable, it doesn't cash flow. And so, just decline out of hand. Now, that is not the SBA rule, okay? The SBA is going to say that you need to be able to demonstrate that you can cash flow in the future going forward. It's probably just the bank's internal policy that says, hey, we don't want to make loans to businesses that were not profitable in the past. And that's okay. The bank can decide to do that, but that's not the SBA rule. So your first job is a tough job, to find a lender who's willing to make a loan based on projections, based on the potential turnaround, right? And be willing to listen to your plans, right? So that's kind of tough job number one. The real reason here, it says most SBA lenders do require the deal to show that the loan repayment will be possible from day one. This is called meeting that debt service coverage ratio. And if the business is not profitable, you'll need to be able to show another repayment source. So oftentimes you might say, hey, look, I have this outside income and I'll be able to make the loan payments. And oh, by the way, we're going to turn the business around and we're going to make it profitable so the business will be able to. But just in case the business doesn't turn around as fast as I thought it was, I've got this other source of repayment. Okay. So here's what you're going to need to do, or some of the things that you're going to need to think through in improving your case and what an SBA lender is going to be looking for. So a turnaround plan with documented improvements. So very specifically, and this is like when we're doing projections for a deal like this, we're really going through line by line, like on the expenses, for example, and we're going to say, okay, this expense was this amount in prior year. We think it's going to be this amount going forward. We're going to reduce this expense by 5% because we're going to do this, this, and this. And, the more data you can back that up with or make that more believable, the more likely the lender is going to be willing to, take those projections as something they can hang their hat on, right? Another big one is additional income source. So I have seen this scenarios where, really the reason that they approve the loan is because maybe your spouse is a physician with a whole bunch of outside income and really steady outside income, and they're willing to co-sign on the loan. Maybe we get comfortable, and maybe the loan amount that you're requesting is relatively small. And so you can get comfortable with a deal that is not profitable. The other common thing is that the seller is, the SBA lender is going to say, hey, why do we want to pay the seller X amount of dollars when their business isn't profitable? Should we be paying them anything? And so having some seller carry or seller note where you're paying the seller over time, the seller doesn't get all of that paid up front. That's another common thing that you would see. Another thing is that, typically in an acquisition deal, you're only required to put in 10% equity into the deal and you can borrow the other 90. But in a situation like this, if the business isn't profitable, probably looking at 20, 30, 40% equity, right, can strengthen your chances. And then collateral, if the deal has collateral and the lender feels comfortable that, hey, even if the business can't repay the loan and even if you personally can't repay the loan, we've got collateral to back this up and we could get our money back that way. Lenders don't want to rely on collateral. That's not what they don't want to get repaid based on liquidating your collateral. They want to get repaid based on cash flow. So that's why this is kind of at the bottom of the list here. That's not really what they want to be doing. So I hope that's been helpful. I think you'll probably find that it's tough. If you're looking to acquire a business that's not profitable or just marginally profitable, it's probably going to be tough to find a lender willing to work with you on that unless you have a strong case from these other kind of factors, right? And so if you have a deal that you're looking at and you want to run it by me, you can reach out to me either over email at support@projectionhub.com, or we'll put a link in the description of the video below to our free SBA review form. And it'll ask you for a little bit of context, a few questions, and then that'll come to me and I can review your deal and kind of give you some feedback and say, okay, here's how I would approach this, or I don't think anyone's going to be willing to fund this, or yes, maybe someone would fund this in these certain scenarios or circumstances, or if you can come up with more down payment or a cosigner, or hey, we need to have a really well documented plan of how you're going to turn the business around and you have experience turning businesses around. Those are the kind of things that we're going to try to help with. So yeah, hope that's been helpful. If you have any questions, leave them in the comments or reach out. And if you think the video has been helpful, I'd love it if you like the video. Give it a thumbs up, subscribe to the channel. We're putting out more content on SBA every day. So we appreciate you. Thanks.